If you can buy assets below replacement cost, you're already ahead of 90% of the market. Let me be clear about something right now. High interest rates aren't your enemy. They're your filter. They're your weapon. They separate the people who actually know how to underwrite cash flow from the people who were just riding a wave of cheap money and calling themselves investors. And right now, in February 2026, we're in one of the most target-rich environments I've seen in decades, not in spite of high rates, because of high rates. Because high rates are exposing every bad decision that was made over the last 5 years. Every over-leveraged deal, every pro forma fantasy, every asset that only worked at 3% debt is now imploding at 7%. And if you know what you're looking for, if you understand how to profit in this environment, you're going to make a fortune. But most people don't get this. Most people think high interest rates mean you can't make money in real estate. They think you have to wait for rates to come back down. They think the opportunity is over. They're wrong, dead wrong. The opportunity is just beginning. Because what high rates do is they reset the market, they force price discovery, they flush out the garbage, they create distress, and distress creates mispricing. And mispricing creates opportunity for people who have capital, discipline, and the guts to act when everyone else is paralyzed. I've been investing through multiple rate cycles. I've made money when rates were 15%. I've made money when rates were 3%. And I'm going to make money now when rates are 7%, because the rate itself doesn't matter. What matters is the spread between your cost of capital and your return on investment. What matters is buying assets that generate free cash flow at a price that works. What matters is understanding replacement cost and barriers to entry. If you can do that math, if you can find assets where the numbers work at today's rates, you don't need rates to come down, you're profitable from day one. And if rates do come down, you make even more. That's asymmetric risk. That's how you build wealth. So let me tell you exactly how to profit in this environment. And I'm going to promise you something right now. Near the end, I'm going to reveal where I see the most overlooked distortion in the market today. Something that's being completely ignored because everyone's focused on the obvious stuff. Something where the opportunity is massive if you know where to look. But first, you need to understand the landscape. You need to understand why high rates are creating opportunity and how to position yourself to capture it. Here's what's happening. From 2020 to early 2022, we had the most distorted capital environment in modern history. Interest rates at 0, quantitative easing, massive fiscal stimulus, money was free. And when money is free, people do stupid things. They overpay for assets. They underwrite aggressive assumptions. They lever up to maximize returns. They assume that cheap money will last forever. And for a while, it all works. Prices go up. Cap rates compress. Everyone's making money. Everyone's a genius until the music stops. The music stopped when the Fed started raising rates. And they raised them fast, from 0 to over 5% in less than 2 years. And suddenly, all those deals that worked at 3% debt don't work anymore. And the buildings that were cash flowing at low rates are now burning cash at high rates. The loans that are maturing can't be refinanced at the old terms. Lenders are requiring equity injections. Borrowers don't have the cash. Defaults are spiking. Properties are going back to lenders. And prices are collapsing. This is exactly what I predicted. This is exactly what happens every cycle when cheap money goes away. And this is exactly where the opportunity is. Because here's the key insight. The assets themselves haven't changed. A well-located apartment building is still a well-located apartment building. A quality industrial facility is still a quality industrial facility. The fundamentals of supply and demand haven't disappeared. What's changed is the capital structure. What's changed is that the debt that was financing these assets at peak prices is now unsustainable. The owners are in distress not because the assets are bad, but because they're over-leveraged and rates reset. And that creates opportunity for buyers who have equity capital and can underwrite deals that work at today's rates. So the first way to profit is simple. Be a buyer of distressed assets. Look for quality real estate that's being forced into the market because of financing problems. Look for owners who have loans maturing and can't refinance. Look for lenders who've taken properties back and need to sell. Look for developers who built projects at peak costs with floating rate debt and are now underwater. These sellers are motivated. They're desperate. They'll take prices that are 30, 40, 50% below what they paid. And if you can buy at those levels, if you can structure your deal with conservative leverage or all equity, if you can underwrite cash flow at today's rates and today's occupancy, you're getting in at a basis where you can make money even if things don't improve. And if things do improve, if rates eventually come down, if demand strengthens, you're going to make a killing. But you have to be disciplined. You can't just buy anything that's cheap. Distress doesn't automatically mean good value. You have to understand why it's distressed. Is it a capital structure problem or a fundamental problem? Is it a temporary issue or a permanent impairment? Is it fixable or is it trash? These distinctions are everything. Because if you buy an asset with structural problems, if you buy in a dying market, if you buy something that can't generate cash flow even at your lower basis, you're not investing, you're catching a falling knife, and you're going to lose money. What I look for is high quality assets with bad balance sheets, assets in good locations, assets with real barriers to entry, assets where replacement cost is significantly higher than the distressed price, assets where the cash flow, even at today's lower occupancy and higher operating costs, still covers my all-in cost, including debt service at current rates. If I can find those assets, I know I have downside protection. I know I can survive if things stay bad for a while. And I know I have massive upside if the market recovers. That's the sweet spot. That's where you make generational wealth. The second way to profit is on the debt side. There's going to be a massive wave of distressed debt hitting the market over the next year or two. Banks have commercial real estate loan portfolios that are underwater. They're going to have to recognize losses. They're going to have to sell loans at discounts to clean up their balance sheets. Special servicers are going to be auctioned off non-performing loans. Debt funds that are over-leveraged are going to liquidate. And if you have capital and you understand how to underwrite the collateral, you can buy these loans at 50, 60, 70 cents on the dollar and either work out the borrower or foreclose and end up owning the asset at an even better basis than you could buy it outright. I've done this before. I bought pools of distressed debt in the savings and loan crisis. I bought loans in the financial crisis, and I'm going to do it again now because the math is compelling. If I can buy a loan for 60 cents on the dollar and the property is worth 80 cents, I have a cushion. If the borrower can't perform, I foreclose and I own the asset at a 60-cent basis. If the borrower can work it out, I'm earning a high yield on my investment. Either way, I win. And in a high-rate environment, these opportunities are everywhere because so many loans are underwater and so many borrowers are in trouble. The third way to profit is through creative financing and structured deals. In a high-rate environment, traditional financing is expensive and hard to get. Banks are pulling back. They're tightening standards. They're requiring more equity. They're not lending on anything risky. And that creates opportunity for private lenders, for preferred equity providers, for people who can structure creative deals that give sellers or borrowers the liquidity they need while protecting your downside. For example, let's say there's a property owner who has a loan maturing. The property is worth less than the loan. The lender won't extend. The owner can't refinance anywhere else, but the property is still generating cash flow. It's a good asset. It just has a balance sheet problem. You can step in and provide rescue capital. You can buy the debt from the lender at a discount, restructure it with the owner, give them time to stabilize the property, and earn a high yield while you wait. or you can provide preferred equity, come in junior to the existing debt but senior to the owner's equity, earn a high current return, and have upside participation if the property recovers. These kinds of structured deals are proliferating right now because there's a huge gap between what traditional lenders will do and what borrowers need. And here's the beautiful thing. In a high rate environment, you can demand high returns. You can get 15, 18, 20% yields on these kinds of investments because the borrowers are desperate, because there's no other capital available, because you have leverage in the negotiation. You're providing liquidity when nobody else will, and you get paid accordingly. This is opportunistic investing at its finest. You're solving a problem, you're providing capital, and you're getting compensated for the risk. The fourth way to profit is by being a long-term holder of assets you buy right. If you can acquire quality real estate at a discount to replacement cost, if you can structure it with low or moderate leverage, if the cash flow works at today's rates, you can just hold it. You don't have to flip it. You don't have to time the market. You can collect the cash flow, pay down the debt if you have any, and wait. Because real estate is a long-term game. Cycles turn, markets recover, and if you bought right, if you have staying power, you're going to build wealth over time through cash flow and appreciation. This is a strategy that's made me money for 50 years. I'm not a trader. I'm not flipping properties every 2 years. I buy assets at the right price. I operate them well. I collect the cash flow, and I hold them until the market recognizes their value. Sometimes that takes 3 years. Sometimes it takes 10 years. I don't care because I'm making money every year from the cash flow. I'm not dependent on selling to realize my return. And when the market does recover, when cap rates compress again, when values go up, I can sell if I want, or I can just keep collecting the cash flow. Either way, I win. But this strategy only works if you buy right. If you overpay, if you rely on appreciation, if you underwrite optimistic assumptions, you're going to get killed, especially in a high rate environment, because there's no margin for error. Your debt service is high, your financing costs are high. If your occupancy drops or your expenses go up or your rents don't grow, you're upside down. But if you buy at the right basis, if you underwrite conservatively, if you have cushion in your numbers, you can handle adversity, you can survive downturns, and survival is what determines long-term winners. Now let me talk about sectors. Where are the opportunities in this high rate environment? Where should you be looking? Where should you be avoiding? Because not all real estate is created equal right now. Some sectors are disasters. Some sectors have pockets of opportunity, and some sectors are being overlooked entirely. Office is a disaster. I've been saying this for years. Remote work has permanently reduced demand. Occupancy is down. Sublease space is everywhere. And the debt that was put on office buildings at peak valuations is now underwater. There are opportunities in office, but they're very specific. You have to buy the best buildings in the best locations at massive discounts, and even then, you might have to reposition them, maybe convert to residential or lab space or something else. Most office buildings, especially in secondary markets, are going to zero. Stay away unless you really know what you're doing. Multifamily is more interesting. There was overbuilding in some markets, especially in the Sun Belt. Supply is elevated, rent growth has slowed, and a lot of developers are in trouble because they built with floating rate debt. But the fundamentals of multifamily are still sound. People need places to live. Household formation is still happening, and home ownership is less affordable because mortgage rates are high. So rental demand is actually decent. The issue is supply and capital structure. If you can find well-located apartment buildings that are being sold because of financing distress, where the seller is motivated, where you can buy below replacement cost, those are good opportunities. Just make sure the numbers work at today's rates and today's occupancy. Don't underwrite rent growth you're not sure will happen. Retail is tough because of the structural shift to e-commerce, but there are pockets, grocery-anchored centers in good locations, necessity-based retail, properties with long-term credit leases. If you can buy those at significant discounts, they can generate solid cash flow. Just avoid dying malls and marginal strip centers. Those are value traps. Industrial and logistics got overbid during the pandemic. Everyone thought e-commerce would grow forever. Everyone was building warehouses, and now there's oversupply in many markets. But the long-term fundamentals are still positive. Supply chains are still being reconfigured. Last mile delivery is still important. So if you can find well-located industrial buildings that are being forced into the market because the developer can't lease them up or can't refinance, those are worth looking at. Just be selective. Not every warehouse is a good investment. Self-storage is interesting because it's got low operating costs and high margins, but it also got overbid, cap rates compressed, a lot of new supply came online, so you have to be careful. But if you can find facilities in supply-constrained markets at reasonable prices, they can generate good cash flow. Single-family rentals are tricky. The big institutions that bought thousands of homes are struggling in some cases because they overpaid and their operating costs are higher than expected. But if you're buying individual homes or small portfolios in good locations at prices that generate positive cash flow, that can work. Just don't assume appreciation. Make sure the rental income covers your costs. Here's the sector that almost nobody is talking about, and this is where I'm going to deliver on my promise. Everyone's focused on traditional real estate, office, apartments, retail, industrial. Everyone's talking about how to navigate the distress in those sectors, and that's fine. There's opportunity there, but the biggest distortion, the thing that almost nobody is paying attention to, is what's happening in senior housing and healthcare real estate. Think about the demographics. The baby boomer generation is aging. The number of people over 75 is exploding, and they need housing. They need assisted living. They need memory care. They need skilled nursing. The demand is massive, and it's only going to grow. This is one of the most predictable demand drivers in all of real estate. You can look at the census data and know exactly how many people are going to need senior housing in 5 years, 10 years, 20 years. It's not a guess, it's math. But here's what happened. During the pandemic, senior housing got crushed. Occupancy dropped because families were scared to put their loved ones in facilities. Operating costs spiked because of labor shortages and infection control. A lot of operators struggled. A lot of buildings went into distress. Lenders pulled back from the sector. Capital fled. And now you have this huge gap between the demographic demand that's coming and the supply of quality facilities because nobody's building, nobody's financing. Everyone's scared of the sector because of what happened during COVID. And that's the opportunity. You can buy quality senior housing facilities right now at basis levels that are below replacement cost. You can buy them from distressed sellers, from operators who over-leveraged, from lenders who foreclosed. And if you have operational capability, if you can run these facilities well, if you can stabilize occupancy, you can generate strong cash flow. And as the demographic wave hits over the next decade, as more and more people need these services, your properties are going to be worth significantly more. This is a classic supply-demand mismatch. Demand is going to explode, supply is constrained, and you can buy in right now at distressed prices. But you have to know what you're doing. Senior housing is operationally intensive. It's not like owning an apartment building where you just collect rent. You're providing services. You have regulatory issues. You have staffing challenges. So you either need to be an operator yourself or you need to partner with experienced operators. But if you can execute, the returns are going to be phenomenal because the demographic math is undeniable. And the capital markets haven't figured this out yet. They're still scared. They're still avoiding the sector, which means you can get in cheap. That's the distortion. That's what nobody's looking at. Healthcare, real estate, particularly senior housing, is going to be one of the best performing sectors over the next decade. And you can buy it right now in February 2026 at prices that will look like steals 5 years from now, but you have to move before everyone else figures it out. You have to have the conviction to invest in a sector that's out of favor, and you have to have the operational capability to execute. So here's my call to action. Stop waiting for interest rates to come down. Stop thinking that high rates mean you can't make money. High rates are your friend if you know how to use them. They're exposing bad investments. They're creating distress. They're forcing assets into the market at prices that work. Your job is to have capital ready. Your job is to underwrite conservatively. Your job is to focus on cash flow, not speculation. Your job is to buy below replacement cost with barriers to entry. Your job is to look for value where everyone else sees problems. If you want to think like an owner instead of a speculator, if you want to build real wealth in this environment, hit subscribe, hit like, because I'm going to keep showing you how to profit regardless of what interest rates do. I'm going to keep emphasizing fundamentals over narratives. Drop your investment theses in the comments. Tell me what you're seeing in your markets. Tell me where you think I'm wrong. I'll answer honestly, even if the truth makes you uncomfortable, because that's how you learn. That's how you get better. That's how you make money when everyone else is complaining about rates. The supply and demand secret that made billions in real estate for Sam Zell